a massive move higher in the markets yesterday, exacerbating that kind of sharp move higher off the recent lows we saw in October. Does that mean this is all clear to get into stocks again?
I would like to hope that that would be the case, but I believe it's short-lived at this point in time. Keep in mind that you do have some headwinds. You have the Federal Reserve that's meeting today. They're going to raise interest rates, we believe, in December and continue to lower their balance sheet. You also have global growth issues in China as well as within the Eurozone. That economy, those economies are decelerating. That also is going to have a dampening effect within the market.
Does that mean that now that the midterms are done and dusted, we now go back to just what we were looking at before? That's trading tariffs, that's possibilities of the Fed raising interest rates, what the pace is going to be. Does that mean that we are now just right back to where we were before?
Yes, unfortunately, that's the case. So you have issues within the tariff side with China that we don't think will be resolved after they meet in another month. Also, you have additional issues with cost pressures going higher here in the United States. And of course, a lot of this embedded expectations for earnings growth as well as valuations is all baked with the over global growth. And if you start to see global growth decelerate, market multiples will come down for the S&P 500.
Jim Cramer last night on Mad Money talked about the Fed, talked about the midterms, kind of we're moving on from there, and now the Fed is in focus again. He has spoken before and has for weeks now about this idea that the economy may not be as strong as we think it is. Do you believe that? And if that is the case, what does that mean for Fed policy in 2019? Let's just assume the market has it right and it's 100% basically baked in that we're going to get a 25 basis point rise come December.
So we believe you're going to get 2 additional rate hikes in 2019. They're going to continue to reduce the balance sheet. That also will have a dampening effect on liquidity in the speculative financial system. So Jim is correct. He's looking at auto trends. He's looking at growth overseas. He's looking at the housing market. And you could see the price action within different sectors showing the market that the overall economy may be decelerating in 2019. You had this huge fiscal stimulus plan that came into play in 2018, and we're seeing that within the U.S. economy. Remember, deficits went from 2% to 5%. Massive fiscal stimulus. That is going to eventually decelerate. That growth is going to decelerate. The Fed may have to then curtail their rate hikes.
All right, so that doesn't sound like the most optimistic of scenarios. It also doesn't sound terribly terrible at the same time.
Right.
So does that mean that you're positioned how for your clients given that kind of more cautious outlook?
So you want to be in the steady Eddie kind of companies, steady Eddie kind of sectors. Look at consumer staples, healthcare. I know they've both had some pretty good runs over the last several months. We continue to believe that that's where you want to reach. Also, you may, as interest rates start to rise, start picking through the utility sector. You may find seams of opportunity there. When it comes to global macro investing, stay more overweight U.S. dollar. We would continue to avoid the emerging markets. We do continue to believe the dollar will continue to strengthen. That will also soften demand there.